Welcome to YCC Capital Macro Research. We don't follow headlines, we follow the data. Every day, we analyze the world's largest economies, financial markets, and geopolitical developments to uncover the structural forces shaping tomorrow's investment landscape. Let's begin. Over the past several months, the global oil market has faced one of its most significant supply disruptions in decades. Yet, despite severe geopolitical tensions, oil prices have remained far below the levels many investors initially feared. Why hasn't the market spiraled out of control? Where has the missing supply been replaced? How long can inventories continue to cushion the shock? And perhaps most importantly, what happens once these temporary buffers begin to disappear? In today's report, we'll examine the data behind global crude inventories, Middle Eastern production, China's demand, US energy balances, shipping costs, and inflation scenarios to understand why the current equilibrium may prove far more fragile than it appears. Global crude oil inventories. The first chart tells perhaps the most important story of the entire report. Global crude oil inventories are falling at a pace rarely seen outside major supply crises. Seasonal inventory patterns normally follow fairly predictable cycles. Across most years since 2017, inventories either stabilize or gradually recover during the middle of the year before tightening again later. This year is completely different. The 2026 observable data and JP Morgan's estimates both show inventories dropping sharply throughout the first half of the year, pushing stockpiles well below historical seasonal ranges. Instead of building inventories as refiners normally would, countries are drawing them down to compensate for disrupted imports. Inventories function much like a savings account. During normal periods, nations accumulate reserves when supplies are plentiful and spend those reserves during temporary disruptions. But savings accounts are finite. Every barrel removed today becomes one less barrel available tomorrow. This inventory drawdown explains why oil prices have not fully reflected the physical loss of Middle Eastern production. Rather than immediately competing for scarce barrels in the spot market, consumers have been consuming oil already sitting in storage. The challenge is that this solution cannot continue indefinitely. Once inventories approach critically low levels, buyers must eventually return to the market simultaneously, increasing competition for available supply and creating the conditions for renewed upward pressure on prices. Iran crude, oil production, and exports. The second chart highlights another reason why supply risks may persist longer than many investors expect. Iran's production collapsed rapidly following sanctions and geopolitical disruptions beginning in 2019. Exports fell even more dramatically, demonstrating how quickly geopolitical events can remove oil from global markets. However, the recovery tells an entirely different story. Production has taken several years to gradually recover toward previous levels. Exports have also climbed steadily, but with considerable volatility. The lesson is clear. Shutting down oil production is relatively easy, but restoring it is remarkably difficult. Oil fields are not like factories, where workers simply flip a switch to resume operations. Wells require pressure management, infrastructure repairs, pipeline inspections, storage capacity, and transportation logistics. Extended shutdowns can permanently damage reservoir performance. Even after political agreements are reached, physical production often lags by many months. The historical Iranian experience suggests that today's supply losses cannot simply be reversed overnight. This asymmetry between rapid production losses and slow production recoveries creates an important structural risk for global oil markets during the second half of the year. China crude oil import volume. China remains the world's largest crude oil importer, making its demand profile critical for global energy markets. Over the past decade, China's crude imports increased steadily from roughly 250 million tons to well above 550 million tons annually. This long-term trend reflects industrial expansion, rising transportation demand, and continued petrochemical development. Although imports have experienced modest fluctuations in recent years, the broader trajectory remains remarkably resilient. This resilience matters because even small percentage changes in Chinese imports translate into enormous shifts in global demand measured in millions of barrels. The data also reminds us that China's oil demand is driven by structural economic activity rather than short-term speculation. Manufacturing, freight transportation, chemicals, aviation, and industrial production continue requiring substantial crude inputs despite the country's accelerating investment in renewable energy. China's energy transition is progressing rapidly, but it remains an evolution rather than a replacement. Traditional fuels continue serving as the foundation supporting industrial growth. Changes in average crude oil import volumes by country. This chart reveals one of the report's most interesting findings. Global crude imports declined sharply during recent months, but China accounted for an overwhelming share of that decline. In March, China represented roughly 11% of the global reduction. By April, its contribution climbed to 36%. By May, an extraordinary 74% of the worldwide decline in imports came from China alone. At first glance, this appears extremely bearish for global oil demand. However, a closer examination suggests a different interpretation. China possesses substantial strategic inventories and significant storage capacity. Rather than indicating permanent destruction of demand, much of the decline likely reflects delayed purchasing while prices remain elevated. Instead of buying expensive imported crude today, China can temporarily rely on existing inventories and wait for more attractive pricing later. This distinction is crucial. Demand destruction implies oil will never be consumed. Demand postponement implies consumption simply shifts forward in time. If postponed demand eventually returns, while inventories have already been depleted, global markets could experience another tightening cycle later in the year. Middle East crude oil production. The Middle East continues to dominate global crude production despite increasing output from North America and other regions. Saudi Arabia remains the world's largest producer by a considerable margin. Iraq, the UAE, Kuwait, and Iran collectively place 5 Middle Eastern producers among the world's top 10. Together, these countries account for roughly one-third of global production capacity. This concentration explains why disruptions in the region have such disproportionate effects on world energy markets. While North America, Latin America, and other exporters have partially compensated for lost Middle Eastern supply, replacement capacity is inherently limited. Alternative producers can increase output only within existing infrastructure constraints. The market therefore faces an uncomfortable reality. The world's largest concentration of low-cost production remains geographically concentrated in one of the world's most geopolitically sensitive regions. That structural dependence cannot be diversified quickly. Shipping company profits. Higher oil prices do not automatically benefit every participant in the energy industry. Major shipping companies experienced dramatic declines in profitability despite elevated freight rates. Several firms saw earnings fall sharply, while at least one major operator moved into losses. Why? Because rising freight rates have been accompanied by even faster increases in operating costs. Higher fuel expenses, insurance premiums, rerouting around geopolitical hotspots, longer voyage times, and vessel shortages all squeeze operating margins. Shipping companies therefore find themselves caught between higher revenues and even higher costs. This deterioration in profitability also creates a negative feedback loop. If shipping becomes less profitable, operators reduce available capacity or delay expansion, tightening transportation markets further, and increasing shipping costs across global energy supply chains. The logistics bottleneck becomes an additional source of inflation independent of the oil price itself. China refinery utilization rate. The final chart illustrates the downstream impact inside China. Refinery utilization has declined noticeably over the past 2 years, with significant volatility across independent refiners. Some of this weakness reflects maintenance activity, but much of it also reflects delayed crude purchases resulting from elevated oil prices and transportation costs. Importantly, lower refinery utilization does not necessarily imply permanent demand destruction. Instead, it suggests production has been postponed while companies wait for more favorable input costs. Once crude prices stabilize and shipping conditions improve, refinery activity could recover relatively quickly. That delayed recovery has the potential to bring postponed oil demand back into global markets precisely when inventories have already been depleted. This is one reason why the report concludes that today's apparent demand weakness may prove temporary rather than structural. U.S. crude oil supply-demand balance. The weekly U.S. supply-demand balance provides additional evidence of how inventories have supported consumption. Although apparent demand has softened modestly compared with earlier months, domestic production continues setting historically high levels. At the same time, net imports have fallen sharply, while inventory withdrawals have compensated for much of the missing supply. In other words, rather than reducing consumption dramatically, the United States has largely maintained domestic demand by drawing down stored crude. This reinforces one of the report's central conclusions. Inventory consumption has delayed, rather than eliminated, the effects of tighter global supply. Once inventories approach operational minimums, this balancing mechanism becomes far less effective. China crude oil imports. China presents a noticeably different picture. Imports from the Middle East have fallen dramatically, reaching their lowest levels in years. However, imports from other regions have increased, cushioning part of the decline. Total imports have moderated, but not collapsed. This reflects China's flexible procurement strategy. Rather than relying exclusively on one region, Chinese buyers have diversified purchases toward Latin America, Africa, Russia, and other suppliers whenever economics permit. Combined with strategic inventory management, this diversification has reduced China's vulnerability to any single geopolitical disruption. Nevertheless, the data also indicate that substitute supplies cannot fully replace lost Middle Eastern volumes indefinitely. U.S. crude oil stocks. The United States has responded to supply disruptions by drawing heavily on inventories. This chart combines commercial inventories, the Strategic Petroleum Reserve, and total crude oil stocks over several decades. Commercial inventories have fluctuated with normal business cycles, but the Strategic Petroleum Reserve tells a much more remarkable story. Following repeated releases over recent years, strategic reserves remain well below historical peaks. Combined inventories have therefore declined significantly from previous highs. These reserves have successfully cushioned domestic energy markets, allowing refiners to maintain operations despite reduced imports. However, strategic reserves exist precisely because they are finite emergency resources. Each additional release reduces future flexibility. The longer global supply disruptions persist, the smaller the remaining safety margin becomes. Markets eventually transition from consuming inventories to competing for fresh production, and that transition often produces considerable price volatility. Global crude oil production. Production trends reinforce the same conclusion. The Middle East experienced a dramatic collapse in output following recent geopolitical disruptions. Meanwhile, production from other major oil producing countries increased steadily, helping stabilize global supply. This divergence illustrates how flexible non OPEC production has become over the past decade. The United States, Canada, Brazil, Guyana, and several other producers have significantly expanded production capacity. Nevertheless, the numbers also demonstrate the limits of diversification. The increase outside the Middle East has not fully replaced lost production. Global markets therefore remain dependent on eventual recovery within the Gulf region. Until damaged infrastructure is repaired and production gradually resumes, global supply remains structurally tighter than headline prices alone might suggest. Global crude oil exports by region. This chart helps explain why oil prices have remained surprisingly resilient despite substantial Middle Eastern disruptions. Middle Eastern exports have declined dramatically over recent months. However, North America, Latin America, and Europe have all increased exports, partially offsetting the missing barrels. This substitution effect has prevented a much larger global supply shock. Instead of losing every disrupted Middle Eastern barrel, the global market has managed to replace roughly half of the missing supply through increased exports from other producing regions. But there is an important limitation. Replacement supply is approaching its practical limits. Many producers are already operating near capacity, and increasing production further requires new drilling, infrastructure investment, and time. Substitution works well for temporary disruptions. It becomes far less effective if disruptions become prolonged. Eventually, the ability of non-Middle Eastern producers to compensate begins to diminish, leaving inventories as the remaining buffer. U.S. refinery utilization rate. Refineries provide another important signal about underlying demand. Despite supply disruptions and elevated oil prices, U.S. refinery utilization remains historically high. Apart from temporary maintenance periods and extraordinary events such as the pandemic, utilization has consistently operated above 85% and recently moved back toward the mid 90% range. This suggests that end user demand for gasoline, diesel, jet fuel, and petrochemical feedstocks remains resilient. Had demand collapsed, refinery utilization would have fallen sharply. Instead, refiners continue processing crude at elevated rates, supported partly by inventory drawdowns. Strong refinery activity therefore indicates that oil demand has weakened far less than many headlines suggest. As we bring everything together, one message stands above the rest. The resilience of today's oil market has not been driven by abundant supply. It has been supported by three temporary buffers: higher production outside the Middle East, aggressive inventory drawdowns, and delayed demand, particularly from China. Each of these mechanisms has helped prevent an immediate supply crisis, but each also has clear limits. If Middle Eastern production recovers only gradually, while inventories continue to fall and postponed demand begins returning, the global oil market could tighten once again during the second half of the year. Under our base case, oil prices are likely to remain elevated around the $80 range before gradually easing, keeping inflation above central bank targets for longer than markets currently expect. The key variables to watch remain the progress of Middle East negotiations, the reopening of critical shipping routes, and the pace at which global inventories continue to decline. Thank you for watching YCC Capital Macro Research. If you enjoy our macro research and data-driven investment insights, please like this video, subscribe to the channel, and visit wacinvest.com/research for our latest institutional reports. We'll see you in the next analysis.